Fios is not cable. We're wired differently, which means you can get the fastest internet available with equal upload and download speeds from 50 to 500 megs. So you can upload 200 photos before your favorite song is finished. Click the ad and switch to Fios today to get our best offer ever.
This is a download from BFM 89.9, the business station.
Good morning, Dodge. U.S. fourth quarter GDP was revised upwards from 1% to 1.4%, but at the same time, corporate margins are coming down. What are your thoughts on this? How is this going to affect corporate health, and is this going to hold down the stock market direction?
Well, it's true. The U.S. economy is continuing to shrug off fears of the global economic downturn, and the three areas that we're strongest in right now are consistent job gains, wage growth, and a resilient consumer spending. All this is good, and the fact that relatively moderate wage growth suggests that our labor market still has considerable room to bring in more workers without spurring high inflation. The three areas in our economy that are good right now are retail, construction, and healthcare. That's good for the short term. In terms of the declining corporate profit margins, however, I suspect this will prompt aggressive cost-cutting and thus a slower trend for non-farm payroll growth later this year and into 2017, which in turn will lead to a slower trend for consumer spending growth.
Now, also, we saw spate of strong economic data coming out of the United States. For the first time in 6 months, U.S. manufacturing activity actually turned to a positive territory. How do you think this plays into the declining corporate margins, as we talked about earlier, and how will this also influence interest rate direction in the future?
Well, it's interesting. I think there's one byproduct that has not been viewed yet, but when decent employment gains combined with sluggish GDP growth, which is what we have, is consistent with persistently slow productivity trends. The push that we're having now to raise the minimum wage to $15 an hour, which gained further impetus here in New York and also in California last week, will probably add to the squeeze on profit margins. Perhaps it will also spur productivity gains as machines become more economical replacements for workers who may be too expensive at $15 an hour, plus the payroll taxes. That would be an unanticipated income in this wage increase. So it's not certain which side is going to win. I suspect there's going to be additional pressure in terms of labor growth.
And what about its impact on interest rates direction?
Well, for now, we're seeing a very cautious Fed. One reason for this caution is that the Fed is looking for more conclusive evidence of a pickup in wage growth. Recent improvements in the labor force participation rate confirm there is a greater slack in the jobs market than might be suggested by the headlines that we're seeing about unemployment. The Fed will be loath to interrupt the process of improvement that we're going through now via much tighter policy, especially given the numbers are being accompanied by below-target inflation readings. So we suspect that there will not be much pressure to increase interest rates in the near future.
Now, the housing market also looks pretty good, with January house prices rising about 6% year on year. Are there any tactical plays here?
Yes, it's interesting. Yes, the number of households remain near October's record high. Yes, the home ownership rate overall edged up to 63.8% of all households. That's improving. It's well away from the 69.2 that we had in 2004. Of course, the big question for single-family home builders is when will the millennials stop renting apartments in the urban centers and buy a home in the suburbs? The home ownership rate for under 35 households ended at 34.7% last year, well below the record high of 43.6%. The number of renters in this age group rose to a record high of 16.4 million at the end of last year. The opportunity here is more in the real estate investment trusts, particularly those that are involved with home rentals, particularly those in areas such as New York, where the millennials are much more prone to renting given the high costs that we're seeing in household production.
Now, the oil organization OPEC is going to hold its meeting in a couple of weeks, and we know that the oil prices have firmed up to around $40 per barrel. What are your expectations in the upcoming meeting, Dodge, especially when the fact that the Fed is also saying they are looking into global factors when considering interest rate hikes?
Well, I'm a little concerned about the potential of anything really happening then. Saudi Arabia's plan to freeze their oil output on the condition that Iran does the same suggests to the market that the meeting in Doha this month will probably go nowhere, and that has weighed on stocks. It's unlikely that Saudi Arabia is going to protect its market share, and they're certainly not going to give it to Iran. So right now there's less optimism for an event that will hold down production, and therefore there'll continue to be a pressure on oil prices, and that obviously will affect the stock market.
Now, we also hear of news that the Saudi government is going to list its national oil company, Aramco. Are you in any way going to participate in this? Are you looking forward to this listing?
I'm looking forward to the listing, but no, we do not plan to participate, but we do value the great volatility that we have been seeing, Julian, in the price of oil and how it affects all prices of stocks across of the whole realm of geopolitical risk, etc. So yes, we're interested in how it goes and whether it's a successful launch and what price it comes out at. But no, we're not going to participate. We participate in the sensitivity of oil prices through the direct commodity and also how it affects particular industries here in the U.S.
Thanks so much. That was Dodge Dorland, Chief Investment Officer for Landor and Fuest Capital Managers in New York.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.
This year, I will chew 117 number 2 pencils.
I will doodle 9 Staples notebooks to death.
When it comes to school supplies, it's guaranteed your kids will go through a lot.
I'll make a whole lot of paper airplanes.
I will lose my backpack.
That's why you get guaranteed savings for back to school at Staples.
I'll give away my last pen to Nathan in math class.
Get guaranteed savings at Staples, and right now, one subject notebooks for just a penny with a $5 purchase. Staples, that was easy. Valid on select SKUs while supplies last. Limits